Hello and welcome to our video on the importance of financial statements in accounting. In this video, we'll discuss what financial statements are, why they're important, and how they're used by businesses and investors. So, let's get started. What are financial statements? Financial statements are reports that summarize a company's financial transactions and provide information on its financial position, performance, and cash flows. The three main types of financial statements are the balance sheet, the income statement, and the cash flow statement. Importance of financial statements. Now, let's talk about the importance of financial statements. There are several reasons why financial statements are important. Decision-making. Financial statements provide essential information that helps managers make informed decisions about the future of the business. For example, they can use the balance sheet to assess the company's financial health, the income statement to evaluate profitability, and the cash flow statement to ensure adequate liquidity. Transparency. Financial statements provide transparency into a company's financial performance, which is important for building trust with investors and other stakeholders. They show how a company is performing financially and provide insights into its assets, liabilities, and equity. Compliance. Financial statements are required by law, and companies must prepare and file them with government agencies like the Securities and Exchange Commission, SEC, and the Internal Revenue Service, IRS. This helps ensure that companies are complying with financial reporting regulations and standards. How financial statements are used. Now, let's talk about how financial statements are used. Financial statements are used by a variety of stakeholders, including investors. Investors use financial statements to evaluate a company's financial health and decide whether to invest in it. They may use the information to assess the company's profitability, liquidity, and risk. Creditors. Creditors use financial statements to evaluate a company's ability to pay back loans and other debts. They may use the information to assess the company's financial stability, creditworthiness, and risk. Regulators. Regulators use financial statements to ensure that companies are complying with financial reporting regulations and standards. They may use the information to investigate fraudulent activity, identify potential risks, and assess the overall health of the economy. Comparability. Financial statements allow for easy comparison between companies and over time. Investors and other stakeholders can compare the financial performance of different companies in the same industry or evaluate a company's performance over multiple periods. This helps provide insights into trends and patterns that can inform investment decisions. Planning. Financial statements are important for planning and forecasting. Companies use financial statements to identify areas of strength and weakness, set financial goals, and develop budgets and forecasts. This helps them make strategic decisions about future investments and operations. Communication. Financial statements are an important means of communicating financial information to internal and external stakeholders. They help investors, creditors, and other stakeholders understand the financial performance of a company and make informed decisions about investments or other financial transactions. Key ratios. Financial statements allow for the calculation of key financial ratios, which can provide insights into a company's financial health and performance. For example, the debt-to-equity ratio shows the company's leverage, the return on assets, ROA, ratio measures the company's ability to generate profit from its assets, and the current ratio measures the company's ability to meet short-term obligations. In summary, financial statements are essential tools for understanding a company's financial performance and health. They provide transparency, allow for decision-making and planning, ensure compliance, allow for comparison and communication, and enable the calculation of key financial ratios.